Excellent. Thanks, Devin, and thanks for those of you who are joining us live. For those of you who are listening to the recording, I'm really excited about today's event and the material that we're going to cover. As Devin said, the reason that this was put together was because we've had many questions over the years. A lot of times, frankly, they're quite similar, understandably, and it just seemed like a great way to put all of this information in one place. We have lots of other YouTube videos, and we've done webinars and podcasts, but this is a kind of a way to systematically put all the material together, organize it, and also, frankly, get perspectives from groups other than us, and to bring some heavy-hitting panelists to our session today. So again, thanks very much for joining. Our hope and thought is that this will save you time and money attending sort of isolated M&A events, whether they be in person or not. This is kind of really a lot of what you would need to understand if you're considering selling, certainly, and whether that's now or down the road. So we put months of planning into this, as Devin said, and this is a 4-hour event. We recognize that not everybody is going to be able to necessarily allot 4 hours in one sitting. So if you can't totally understand, please feel free to join us for one of those sessions later. Also, as Devin said, the recording will go out, and we welcome you to listen to it that way as well. So my name is Hartland Ross, and I'm the president of eBridge and the host broker. eBridge is our marketing division. We started that over 20 years ago, focused on IT service firms, and then we spawned out the host broker, which is our M&A division, and that was about 18 years or so ago. And all we do is work with IT service firms, of which MSPs has become, anyway, a big portion of the work that we do. And so this session today is really geared towards MSPs, and I will be running this first session, and then Devin will be facilitating later and helping out as well, and then Lyle, as Devin mentioned. So please feel free to ask any questions if you have during the session. I'll try to get to them. We'll try to get to them. If we don't, we'll be including answers to your questions in the recording as well. As I said, the perspective that we're coming at this session, or all these sessions really, will be more from a seller than a buyer. However, I would argue that at some level, everybody is going to be a seller at some stage. It may not be this year, it may not be next year, but at some point. And so understanding the perspective of a seller, even if you don't consider yourself one now, I think is a useful exercise. And the process that a seller would need to go through. So so we're going to jump into the first session here, and as I said, I'm going to be leading it. So the first topic is related to deal process, or sort of before you even go down this road. Let's just talk a little bit about the process and about the market. Okay, so we've got a poll question here that Lyle's going to put up, and I wondered if you could just answer whether you consider yourself to be a seller or a buyer. And that, as I said, either way is fine, but just know that we'll be focused our kind of commentary, I guess, around the assumption that most people are going to be sellers. Let's give a sec to answer. So actually, looks like we've got more, slightly more buyers on than sellers, but it's close. And as I said, I think that anybody who's a buyer, you'll get lots of value out of today's session anyway. So that's helpful to know. So really, the first thing that I wanted to talk about is why MSP owners decide to sell. So we get this question, well, who are the sellers, and what's driving that? And for a long time, maybe showing my age, but I've been hearing about, well, there's the baby boomers, and their kind of grand retirement plans are coming, and we're seeing that, and we're seeing this sort of bubble move through time, and that these baby boomers are going to be set to retire at some stage. And frankly, we're now starting to see that, right? It was years of talk, but at least from our perspective, and frankly, it's not scientific, but just in terms of the anecdotal experiences that we have with the rationale for why someone's interested in selling, retirement is coming up. And even if the retirement answer isn't I want to retire today, it's that I want to retire in 2, 3, 4 years, and I want to start really thinking about what I need to do. And in some cases, some groups are interested in more of a soft landing. So, I don't want to stop working today or tomorrow, but I do want to see if I can sell my business and then be an employee of some sort, maybe a VCIO role or whatnot, for some period of time, and then sort of fade out. But at least I'll know that I'll have my customers taken care of, and it'll be easier for me to exit rather than having to sort of sell and then exit. And recognizing that most buyers would value having the seller stay on for a period of time. So if you're looking to retire tomorrow, selling your business tomorrow might not be the best, because it's the expectation in a lot of cases is that you would stay on for some period of time. Lack of passion and interest is another big one. So groups that have just, whether it's just been a kind of a slog for 20, 30 years. We hear comments around the fact that someone hasn't taken a vacation in extended period of time. IT is obviously a 24/7, 365 kind of business, and it takes a toll. I mean, I don't need to tell you that. So we get these comments that people just sort of feel like I just don't have the energy in me anymore to kind of drive this. And so they look at seeing if they can find a buyer who can take the business over and build on it, particularly if they have strong relationships with their customers. They may be friends and family, and they just feel like they're not maybe doing the best job of servicing those customers. Another one is pursuing another business, right? So someone has another business either in parallel, they have a business right now, and sometimes that business is growing quickly, maybe even growing more quickly than the MSP business, and they need to make a decision, can't continue to do both, and they decide to sell the MSP. And in other cases, they might just choose to pursue another business. Real estate's certainly a common one that we hear going into real estate investing or whatnot. Another one is software of some sort is reasonably common, but we've had lots of crazy things that I thought people would not that common. A fellow a few weeks ago had another business that was a beekeeping business, and that was taking off, and he wanted to look at focusing on that. Health challenges and divorce are two other, not, I wouldn't say common ones, but they certainly do come up. And in some cases, they're unfortunately dire situations. In other cases, they are just that someone sort of feels like they can't kind of keep up the momentum, and circumstances dictate that they need to free up their time, if you like. So let's just talk a little bit about market conditions. This is another question I get, and honestly, I had it yesterday. So tell me about the market. What's the market like right now? And my response is that it's active. It's very active. It's been active for many years now. I like to say that COVID was kind of a gasoline on what was an already burning fire. I can only speculate as to why that was, but I think that it was difficult for a long time obviously for in-person meetings were challenging. And so to the extent that MSPs were trying to grow their business through marketing efforts and going out and doing presentations and so forth, it was not easy. At the same time, we had, in some cases, as much as some businesses were struggling, others were getting relief funds, and there was good periods for some people there, and they were using that extra cash to reinvest in their business. Growing through acquisitions was something that could be done virtually. I didn't need to go out and meet people necessarily, and was a way to bolt on a customer base relatively quickly, and also of course take advantage of some groups that were feeling like, well, maybe now's the time I need to get out of this business because they were struggling. We're also seeing interest from other sectors, printer, copier companies that are coming in. Obviously, these groups already have the right customer base, they have relationships, they have accounts, and so to sell managed services into those customers makes sense. And so they're one group that we see, not a lot, but we certainly see them. Accounting firms on the odd occasion are involved. And then, of course, financial buyers, so private equity groups, investors that are being interested in this, becoming interested in the space as a result of the concept of recurring revenue, the fact that a lot of MSPs are getting larger. Years ago, they were all much smaller, but now large enough that they're attracting those types of businesses, and they obviously like the recurring revenue model, much like SaaS, the SaaS space. So what's involved with selling an MSP, right? So what are the steps? And certainly if you're considering selling, this is really important to you. But if you're looking at acquiring an MSP, then understanding what a seller has to go through and the information that at the very least we talk about would be helpful, I think. So first of all, we feel that getting on the same page, setting expectations is fundamental. And the idea of from a valuation perspective, time commitment perspective, what does that all look like? What information needs to be prepared? What is expected of me, being the seller? So we're going to talk about contracts, for example, as one of the big first items. Do you have contracts in place? And if you do have contracts in place, and that typically would represent your recurring revenue, what percentage of the revenue is that? Can those contracts be assigned? Can they be assigned to a buyer? Are those contracts cancelable? Oftentimes we'll see that someone says, yeah, I have contracts in place, they're annual contracts. Then we'll ask the question, well, what are the terms of those contracts? Can they be canceled? Is there an out clause? And the answer is, yeah, it's a 30-day notice. And unfortunately, a 30-day notice period on an annual contract is essentially a month-to-month agreement. And so what buyers are looking for is some degree of certainty of revenue and having ability for a customer to cancel, or have a customer to cancel because there's not an assignment clause, meaning they can get out of the agreement if there's a change in ownership. Then this creates challenges with enforceability of the contract. Now, I know a lot of sellers say, well, we do business with customers because they want to do business with us, and we don't want to force them, and we don't want to have a relationship with a customer who doesn't want to work with us. All of those are very valid reasons. The reality is that if you're looking to keep the business, that may work for you. If you're looking to sell the business, buyers are not looking to sort of roll the dice on the certainty of the revenue that they're buying. So if there is a risk, they're going to have you share some of that risk, and to the extent that you have contracts, that's going to mitigate that challenge. Customer concentration issues, do you have that? Oftentimes we see that 10% is sort of the threshold with which a buyer will get concerned about customer concentration. If it's less than that, usually not an issue. But if it's more than that, then we need to start talking about, well, are these customers on contracts if there's more than one? And what percentage of the business do they represent? How long have they been customers? And what are some strategies to mitigate, and what are the expectations with respect to how to manage that customer, and what buyers are going to likely approach you with or propose as potential solutions. What about employees? Do you have employees? First of all, if you do, and obviously most people do, but in some cases there may be groups that are running very small operations, and if the employees, likely they haven't been spoken to. Typically, that's not a good idea before an agreement's in place. And so, if that's the case, do you expect as the seller that the employees would transition over to the buyer? And under what circumstances are there some nuanced aspects of that? For instance, they work from home and they want to continue to work from home, for example, or vice versa. They work from the office, and now you're, as a buyer, there's a virtual team that the buyer is running, and will the employee be interested in that type of a structure? What about any sort of on-site work, or is the work can it all be done remotely? And that has implications for a buyer. And to the extent that all the work can be done remotely, that would be to your advantage as a seller, because then that opens up the door for anybody to be able to take over that business, and anybody from anywhere, I should say, as well, geographically. Revenue trends, is the business going up? Is it flat from a revenue perspective, or is it declining? If it is going up, what is the driver of that, right? So the nature of the earnings, is it from managed services, which is the ideal because that's the recurring piece, or is it really coming from more sort of project and hardware sales? And if so, what's the likelihood that the revenues will be maintained in years to come if there's a spike as a result of sort of project and hardware software sales? So a buyer will likely feel that, well, maybe this is an anomalous year, and do some sort of an average over the last few years as an example. Normalizing the financial statements is another big discussion point. And so what we want to do is we want to normalize, adjust the financials so that they are going to end up being representative of what a buyer would be looking at if they were to take over the business. So one of the big ones that we see is owner salaries, and this is either low or high, usually low, but not always. And so if you, the owner, are paying yourself, $40,000, $50,000 a year, but if you were to go out in the market and hire a replacement, and that replacement's going to cost 120, obviously your profitability is going to look great because you're only paying yourself $40,000 or $50,000, but in fact it should be put in as 120. So we need to adjust that. Sometimes there's for instance, a lot of times a wife who might be managing or spouse, I suppose, managing the HR, payrolls, accounts receivable, accounts payable, and that person may or may not be paid, or they may be paid a lower salary than would be considered market. Travel and entertainment costs. So you go to a conference and you decide that you're going to spend an extra few days on the beach. You run that through the business. Well, that's not realistic in terms of what a buyer would entertain. So we want to adjust that downwards, so reduce the expenses, and of course that would increase profitability. Healthcare is another one where there might be some additional healthcare expenses or levels of care that are provided to the executive team, the ownership team, and that may or may not be representative of what a buyer would realize if they were to hire someone to replace you. So adjusting that. Phones and vehicles for personal use is another big one. And then on the revenue side, we sometimes see the disposition of assets. Okay, so this is going to be selling of a fleet vehicle, for example, where they're selling the fleet vehicle for, say, $20,000. That's not operational income. It's not income from providing managed services. It's non-operational income that needs to be removed, and that becomes an adjustment. So Devin's going to actually do a deeper dive into this topic in another session outside of ExitCon and going through the adjustments in much more detail. And so I won't sort of go too much more in that, but that's the concept, and we want to go through that in order to come up with an adjusted EBITDA figure, and that will be the driver of the valuations. And our topic coming up is on valuations, and so if that's a topic of interest to you, I suggest sticking around. And another big one is our customer waterfall or profile. And candidly, we don't see this enough from opportunities that we work with that are with sellers that are working with other intermediaries or brokers. For us, we like to put together a customer waterfall. What this means is that the names are redacted. Okay, so there's no customer names. It's just going to be a customer ID. It might be some kind of initials, if you like, but essentially a list of all of the customers, how much they pay on a recurring basis. If there's project revenue in there on an annualized basis, that's helpful as well. And if they're on a contract, what the terms are of the contract, when it was renewed last, when it next renews, and any terms of that contract, and then the services that are in general being provided, and a bit of a qualitative discussion that this customer has been opening offices across the country. They expected to open 10 new offices the remainder of the year, and so this customer is expected to continue growing, for example. So that's one of the deliverables, and that may or may not be easy to put together. If you have hundreds of customers, typically we would just look at the top 25 or so, depending on how difficult it is to get that information. Providing, as a seller, you need to provide background information on some reports from the business. Okay, so for example, the number of tickets, support tickets, and time to resolution will be asked. Employee compensation, again, no names needed, just initials or the position, and the certifications that are held, the compensation that's being paid to those employees when they last received a salary review, breakdown on vendors and the associated costs, and if there are any contracts in place as well. So let's just switch gears here a little bit and talk about the types of MSP buyers and their approach. And really, this falls into two main categories. The first one is what we call strategic buyers, and the second one is financial buyers. Okay, and strategic buyers are frankly more common. We see them representing, I would say maybe 80% of the buyers that we end up speaking to. These are owner operators who are looking to scale their business, and they have an MSP now. They want to grow, whether it's locally or whether they want to have a presence in another city, East Coast, West Coast. That might be, hey, they're in Northern Florida, they want an office in Miami, so they have a Southern Floridian exposure. So that could be a play, for instance. Generally, strategic buyers are willing to pay the most because they see the most potential for strong synergies, and you may be solving a problem for them. For instance, if they're in Northern Florida, they've just secured a customer in Southern Florida, but they don't have any boots on the ground. Now you have a business in Southern Florida, and hey, you have an office, you have a team, and they can acquire you. There's an acqui-hire type of appeal there, so they can solve their issue relatively easily. And so the time for them to try to do this on their own, the risk associated with it, means that they're willing to pay a bit more. So that's again, these are generalizations, but typically we end up seeing that they're being able to be a little bit more aggressive. And some cases they might be self-financed, so they can simply write a check as a result of cash flow from operations that they have, but they also might have some external lenders or investors. Best case scenario, they have all of those, so they say, well, we prefer to borrow, but worst case scenario, if we can't or get denied, we have a backup, and we can write a check for at the very least the amount on close. If we look at financial buyers, on the other hand, so these are private equity groups and investors, they are looking for typically larger opportunities. So $1 million and more in EBITDA, usually, sometimes as low as 500,000, but usually $1 million, and something like $5 million in revenue. And the reason is that they need the business to fit into a nice box. They have a fund that is driving this, providing the financing. They need to generate a reasonable return for their limited partners, and they can't pay more than a certain amount based on their projections, their modeling. They also typically would require a management team to be in place. And they need that because they're not in the business, although they may have a company in their portfolio that's an MSP already. They need the business to be able to run itself. And so that's one of the reasons why they look for larger businesses, because they're looking for management teams that simply can take over. At the lower end of the range, they might go a little bit less, for instance, the numbers that I gave, but those are going to be considered a tuck-in. And a tuck-in meaning that, hey, we're in the same city already, we're already in Northern Florida, and you have a business in Northern Florida, and so they can either do away with the team, or at least create some synergies, and can tuck that business into their existing operation and use their back office for the admin and support. As opposed to a platform play where either they're not in the MSP space entirely, and this is going to give them a foothold, or there's some other reason, whether it's geographic or otherwise, where they need autonomous operation, a platform to be able to enter the market. And a lot of times as a seller, groups view private equity or other financial buyers as not quite not ideal, not as positively, and that's really as a result typically of their shorter time horizon for investment. So depending on where they're at in their fund, they may be looking to shut the fund down and package it up and sell it. When I say shut it down, it's packaging it up and selling it to another private equity group or otherwise. And that may happen if they're a number of years into the fund already. That may happen a short time after they close on your transaction. So your customer could have their boat rocked, a couple of times in a relatively short period of time. So that's certainly a question to ask if you're speaking to them. And also, as I talked about, there's limitations on the valuation, and they also may or may not want to keep the same number of employees, simply because it becomes a financial exercise more for them, more so than it would otherwise for a strategic. So let's talk a little bit about what buyers are looking for in due diligence, and this will be of interest to both buyers and sellers. So these are not necessarily a comprehensive list, and not in any particular order, but let's just talk about financials first, because this tends to be the one that groups start with, and looking at the last 3 years of financials and the year to date if you're partway into the year. And buyers are going to be looking for trends in revenue. They're going to be looking for ways that they can realize cost savings, and looking through the adjustments that we talked about earlier, and rationalizing those, and trying to figure out whether they can get behind those, or there are further adjustments that they feel would be needed to take over the business. So looking at the financials, and having a clean set of financials, so the correct categorization of expenses is key. Having cost of goods sold, above the line, so you have your fixed costs and your cost of goods sold need to be categorized. Sometimes we see cost of goods sold below the gross margin line. Pricing is another big one. And so this is, again, important to both sides. So if you are a seller, you want to make sure that, although it might sound like it's not a big implication, but if you're charging, let's say, $75 per device or per seat, and there's a buyer who is charging $200 to their customers per device per seat, then is it possible to bridge that gap, right? That's a pretty significant increase. So are the services aligned? Probably not. Can you move a $75 a month customer to a $200 a month customer? Frankly, probably not, which means that the customer is not going to stay, which is not in the benefit to the benefit of either side. So understanding whether that gap can be bridged, and if it can't be, and the customer churns, depending on how the deal is structured, the seller may pay the price for that, and of course the buyer is not looking to have customers churned either. Is there customer concentration? We talked about that as well. And so if you have customer concentration, there's not really a lot you can do about it. And certainly I would suggest to you, if you're a potential seller and you've got that challenge right now, really the only thing you can try to do is to get your other customers to spend more, or to secure some other customers. You don't want to say no to existing business from a large customer. A lot of times those customers have grown or growing more quickly than everybody else, and that's one of the reasons why they end up being this giant whale. But it's a challenge without question. What about the support? And I mentioned this briefly earlier, but does the support need to be done on site, okay, boots on the ground, or can it be done remotely? How does that work with respect to a buyer's business, and can they support on site work if need be? Obviously, if they're going to take over the employees, then it's workable, but otherwise it can be a bit of a challenge. Understanding the employee profile. So buyers are going to want to ask you as a seller who you have on your team. Would you keep all these people? And as we talked about earlier, understanding of their compensation, their certifications, their roles, and a bit of an org chart. Contracts, if they exist, we talked about those as well. So they're going to want to see typically a either templated version of those contracts, right? Or a contract that's been signed by a customer, but you can redact the information as a seller and suggest that you do so, and that will be something that they're going to want to review vis-a-vis their service level agreements and see if they're aligned. What portion of the revenue is recurring? So what we're talking about here with recurring is non-subscription revenue, right? Subscription revenue is Microsoft 365, for example, or Adobe licenses or Dropbox licenses or something. So buyers are interested in recurring revenue, but they're interested in managed services recurring revenue. They're not interested in so much in the revenue where there's a cost of goods sold, simply because the margin's less. So to try to differentiate between those two, and can you do that? Do you have that number? That will be a useful exercise to go through. When you're talking to buyers, what about industry alignment, right? Do you both service the same industry? That will end up being a benefit, and also, frankly, you'll lose prospective buyers if there isn't alignment, but that's okay. So if you focus on healthcare, you're going to really attract buyers who focus on the healthcare industry. Similarly whether government or education. But if you've got a fair bit of healthcare, but government and education, and the buyer only wants healthcare, then they're less likely to be interested because they may not have the expertise to take over the government and education. And then what about the services that you provide? So do you provide VoIP, cabling, networking? Sometimes I've seen marketing in there, software development, website maintenance and development. If these things are in there as well, it makes it difficult to find a buyer who's going to be a good fit, simply because now you've diversified your offering so much that a lot of buyers are going to say, well, we don't offer those services, and we're not interested in offering those services, and so they'll either not value it, meaning you're not going to get paid for it as a seller for those services, or they're going to have to take them over and then shut that portion of the business down, or maybe try to resell it if they try to go down that route if it's significant enough. And chances are they'll lose interest. So 2 more points here to cover. I want to talk about the mitigating risks in an acquisition. So another question that I get from sellers is, well, I talked to my friend and he sold his business and he didn't get paid the full amount, or something went sideways. And so, they come with all these concerns and want to understand, how we can address that. And the reality is there are risks, right? Like we can't eliminate those entirely, but they're primarily, first of all, related to a deal not closing in the beginning. So you're going to spend weeks, perhaps a couple months, and then find out that, well, the deal doesn't close. Now that doesn't happen very often, but wouldn't be reasonable to say that it doesn't happen. There are ways to mitigate that, and I'll cover that shortly. Also, if it does get closed, then the next one, of course, is, well, am I going to get paid? And am I going to get paid on time? So, what are some things that you as a seller can do to try to mitigate that? As a buyer, recognize that you may be asked for some of these things. So obviously getting more cash up front is one solution. So we have sellers that say, well, I don't want to finance anything. I just want to get one check and be out of there. But that comes with a trade-off, and it's a significant trade-off that you need to appreciate, and it comes with a trade-off of in your valuation, right? So to the extent that a buyer has to take on more risk and put more capital up front with a time value of money, then the offer is going to be lower. And so this will come up in the valuation section that we're going to be covering in a bit. but just recognize that, yes, it sounds like a simple answer, but at the same time, also, if you don't have contracts in place or you have large customers, it may not be even feasible. A really big one is maintaining trust, right? So mitigating risk comes from ensuring that both sides are engaged in the process, both sides want a win-win, that a successful outcome is important for both sides, and ensuring that trust is maintained throughout the process and post-close is critical. I say disclose all the skeletons that you have in the closet, if you have any. Sometimes we see, and this is sort of Murphy's Law, that you had that customer for 15 years and they haven't gone anywhere, they've been with you, they've been loyal, but when it comes time to sell, that's the point at which they give notice that they have been acquired or bringing the services in-house or whatnot. And so to disclose that information as quickly as will at least go a long way towards maintaining trust, and the seller may be willing to work with that. They understand things happen. What they don't want to do is be discovering these things themselves. Another big piece is just to reduce risk is just to keep the process moving. If it drags on, then you as a seller are going to feel more frustrated that, geez, well, we went through this process for 3 months, we were sort of at the altar for an extended period of time, and then the process fell apart. And so if you keep it moving, you'll at least force a no if there is going to be a no sooner than later. And that's ultimately, you want a yes, but if there is going to be a no, you want to find out sooner than later. Obviously, you're going to have an agreement in place. You're going to have an LOI, which is typically non-binding, but you're going to have a purchase agreement, and having that purchase agreement reviewed by an attorney is going to be key. Sometimes groups, if it's a smaller transaction, will try to find something on the internet, but highly recommend that you have an attorney draft the agreement. Typically, that's drafted by the buyer, not the seller, but technically it could be done by either side. And that agreement be reviewed with the intention of trying to get a transaction over the line, not trying to necessarily nitpick every detail, but provide that level of protection. So again, mitigating some of these concerns. And then the final piece is just to put funds in escrow potentially, but recognize that if a buyer has to do that, then they have to come up with the cash up front, and there's a time value of money for them. And so if they're borrowing that money, well, they give you a certain percentage up front, and then the rest of it's sitting in escrow that they're paying interest on, and that's not ideal. There's a cost to escrow as well, and so and it doesn't accommodate if there's any kind of an earn-out type of structure. You could put a lien on the business if it's possible. If there's assets that can be lien, so if there's real estate, if there is hardware, servers, equipment, then that's another possibility. A fleet vehicle, but typically with MSPs, there aren't a lot of kind of hard tangible assets that can have a lien be put against them. So that one's not necessarily that easy to implement, but is a possibility. And then another one, just personal guarantees, right? You can ask for a buyer to provide a personal guarantee. They may or may not do so, but you can certainly ask. And then look, the last thing that I want to touch on here is just selling, an MSP, selling your MSP through an intermediary, a broker, and talking about the pros and cons. And obviously, I guess we're biased, right? But our perspective is that an intermediary really adds a ton of value. The number of deals that are successfully closed is much higher with an intermediary. It allows for a check-in, a filtering on frankly both sides prior to requests and offers of, hey, I'm thinking of countering with this. Do you think that would be reasonable? How do you think that's going to go over? As a seller, these are I had some concerns with them. I was concerned that they didn't really seem to be that interested, or the fit didn't seem to be there. And so there's somebody to sort of bounce some of these ideas off and to explore if there is a concern, to explore whether there's merit in that or not, and also outing those concerns in a way that can be well received by the other party. And then sort of somewhat related, but it's just getting ahead of issues, right? So if there is an issue, how does that get presented, and ideally, have it land better with the other side, rather than have someone take it personally and be poorly received. So if there is an issue, and I talked earlier about, let's say a customer gives notice that they're not going to renew, that conversation can be had with the seller and us in advance, and then we can formulate some solutions on, okay, well, what can we do here? Why is this person leaving? Is there an option to save them? When is that going to happen? Can we reduce their contract rather than having them leave entirely? Are there services that they're looking for that you're not providing, but maybe the buyer can provide? And so the buyer can save that relationship. And we've had that before by bringing the buyer into the process. Now it becomes a bit of a scramble, but it's definitely a possibility. And then just general advice and suggestions throughout the process as alternative options to accomplish the same thing. So someone might come back with a structure, and then we say, well, we don't think that's an ideal format, and here's why. What are you trying to do? What's the purpose? And then is there another way that we can frame that to accomplish the same thing? And I talked earlier about keeping the process moving. When there are two groups who are not professionals, there's a buyer and a seller. They don't do this stuff all the time. Even as a buyer, if you're experienced, the seller is probably not. And so trying to keep up that momentum and providing faster time frames for deadlines, ensuring that all parties are adhering to deadlines. In terms of, all right, well, we need offers in by this point. We're looking to complete due diligence by this date. We need to get a purchase agreement out within, typically we like 3 weeks of a close or earlier, or like even earlier time. And the closing deliverables, have those all been done? So we go through the checklist and just kind of keeping everybody accountable. And as I said earlier, if a deal isn't going to happen for one reason or another, we want to find out earlier than later. And so to the extent that a deal drags on, then it's not going to be ideal for either side. And we can play the good cop, bad cop situation, right? So if you as a seller are going to work with a buyer, you want to have a strong relationship with them, particularly if you're going to stay on for some period of time for transition. And so we can be the ones to have those difficult conversations and not have that be you as a buyer or the seller, frankly. And then we typically see higher valuations because there ends up being a better fit, right? And a better fit equals ultimately, especially if there's an earn-out situation, it ends up being a larger payout, and that's a win for everybody because a better fit is just a better fit for everybody, right? Not just from the perspective of the seller. And then just the ability to identify buyers who are maybe not the best fit for one reason or another. They might not have the necessary knowledge to complete a transaction or the resources to kind of get it over the line, or frankly just the drive time to really keep up that momentum. So from just overall, we feel that there's a lower chance of a seller being strung along for extended periods of time with inexperienced buyers who might lack funding, lack a plan, timelines, and strategies. So to try to again move that process along and evaluate the different opportunities and options. So with that, that is where I'm going to park it for our first session here. We've got 10 minutes before the next one. I'm just going to look to see if we have any questions. Looks like there was a comment here from one person saying that they'd worked with other IT shops to help support each other with vacations and so forth. So they said that that's worked out well for them. And if anybody else has any questions that you'd like to post, please go ahead and do so. There is a question here. Actually, I see related to timelines for an acquisition. Typically, we see acquisitions taking somewhere in the neighborhood of minimum 3 months. Usually we advise 4 or 5 months, and that's going to break down in terms of 6 weeks or so to kind of market the opportunity and receive offers, a couple of weeks to evaluate offers, so that brings you to 8 weeks, 2 months mark, and then another 2 months, 60 days for due diligence, sometimes as much as 90 days for due diligence. And if there's an SBA loan involved from a buyer, then it could even be 120 days. Even if there's proposed 90 days, it's oftentimes goes a little bit longer. So with that, I'd like to thank everybody who's on the session here. I'm hoping you can stick around for our next one. We have a great lineup of panelists. We're just going to pause here for a quick break for 10 minutes, and we'll be back. So thank you very much for joining, and hope to see you either in the next session or one of the next three. All right.